Hello, everyone, and welcome to At Barrons. I'm Andy Serwer, and welcome to our guest, Bruce Van Saun, CEO of Citizens Financial Group. Bruce, great to see you.
Yeah, my pleasure.
So talk to us about CFG. It's one of the 20 largest banks in the United States, about $226 billion in assets. What's the focus of your institution?
Well, I like to think of us as having a tripod in terms of our strategy. So the main first element is a transformed consumer bank. So we've got a big consumer bank with 1,200 branches, 6 million customers, big solid deposit base, provide advice to people on their life's journey. The second element is we call it the best positioned commercial bank. So we have a really strong corporate bank focusing on middle market companies, middle market sponsors, really well positioned. And then the third element is fairly recent. We're building out, we hope to be the premier bank-owned private bank and private wealth manager. And that comes on the heels of hiring a bunch of talent from the failed First Republic Bank.
Right, a lot going on in the sector. We'll get to that a little bit. The stock has been a strong performer over the past 12 months. Before that, lagged a bit, the S&P 500, along with the bank index. So what explains both the underperformance with the index, to be fair, and the outperformance subsequently?
Well, last year was a tough year for banks with the two bank failures, largely brought on by the Fed aggressive move to raise rates really quickly, which had a negative impact on banks' net interest income, and there were concerns about potential economic weakness. And so bank stock prices tend to trade with the view of the economy. So if the economy is kind of questionable and you have this high rates phenomena, which is impacting the cost of your deposits, there was a sell-off banks last year. This year, things have stabilized, and so the Fed had paused, and now they're starting to bring rates down. You have also the election is behind us, the uncertainty is behind us. Trump brings a more kind of pro-business, lower regulatory posture, which is seen to be good for banks. And so I think you put that all together, the future looks strong for the economy, less regulation, potentially more consolidation in the space. It's been really good for bank stock prices.
No, but give yourself some credit, Bruce. I mean, you outperformed the index over the past year. So what's that?
Well, I think it gets back to what I just talked. We have a really good strategy, and so the market likes the fact that one of the things we did 2-3 years ago was get into the New York market. That was a hole in our footprint between New England and Mid-Atlantic that we had to figure out a way to solve, and so we bought HSBC's East Coast branches. We bought Investors Bank, put that together, 200 branches, 1 million new customers. That's going exceptionally well, fastest growing region. Household growth in the mid-single digits, deposits in high single digits. So we're executing well on that. And I mentioned the private bank. We're hitting all our metrics in terms of deposits and AUM. It's going very well. So that's seen as positive, plus the fact that we will have some of our hedges for interest rates that are costing us money burn off over the next 3 years. And so you can see a clear path to seeing improved returns. So I think it's those two things really that are causing that outperformance.
The analysts see that latter point you made about the burning off part is probably something that they're responding to as well,
Yes.
I guess. Yeah. So when you talk about coming into New York, and I know you've got aspirations in the West Coast as well that you're fulfilling, I'm wondering about how saturated these markets are. It seems like there's banks all over the place. There's de novo banks, there's legacy institutions. How do you fit in and make money?
Well, it's certainly not for the faint-hearted to come into New York. We call it the belly of the beast with all the big mega banks here and lots of other competitors. But we have confidence in our way of banking, the way we serve customers and provide thoughtful advice on their life journey and good customer experience. So we've come in, kind of taken the fixer-uppers that we bought and brought it up to our level of standard. And I think there's always room for banks who really engage in their communities and understand their customers and provide that good advice. So, we've held our own for years in Boston and Philadelphia. We go up against all the big players in those markets, which gave us the inspiration and confidence that we could come into New York and do well. It's certainly an expensive market to do business in, so we're spending a lot on advertising to get our brand out there. We sponsored the New York City Marathon this year. So that's also, goes into, making sure that we can come in, gain awareness, and then compete effectively.
Yeah, as a runner, I appreciate that sponsorship. So
Have you run in the marathon?
I ran just this recently.
Oh, did you really?
Yeah. So you mentioned the hiccups that we saw in the banking sector a year or so ago. How safe is the banking sector, Bruce?
I think it's really safe. Those banks were, we like to say it was idiosyncratic. They weren't really part of the regional bank group, the traditional regional bank group. And they had niches. The Silicon Valley Bank focused more on tech companies and VC, and First Republic on wealthy folks. They grew at extremely rapid clip from like 50 billion, both of them, to over 200 in like 4 years. They took in a lot of deposits. They made fixed rate loans or invested in fixed rate securities. And then when interest rates went up, they really didn't have the right sophistication to put the hedges on the balance sheet to protect against that. What happens though is then the regulators come in and they say, uh-oh, the whole system's a little creaky. We need banks to hold more capital, issue more permanent funding that's expensive, hold more liquidity. And so that was kind of the proposals that we had to push back again next year to really direct people that, look, the system is safe. If we put all this extra security into our balance sheets, it means less room for lending, which less capital for customers, less capital to support economic growth. And so I think we've had some good success with that. I think the capital where it is today is about the right level. Maybe ultimately the proposals will increase it a little bit, but the system is very safe.
Or, as you suggest, though, in the Trump administration, there may be less regulation. Are you concerned about things getting rolled back too far and some cowboys taking advantage of that situation?
No, not necessarily. I go back to Trump 1.0, and after the great financial recession under the Dems, things had improved. There were certainly fixes that had to be made, but the pendulum usually swings too far. And under Randy Quarles and some other agency heads, they brought the pendulum back more into equilibrium. Then I think in the last 4 years, we've had the pendulum go out again with these proposals. I think the people that Trump appoints will probably just try to find that sweet spot in the middle again.
I want to ask you about interest rates and how where we are in the rate cycle informs you in terms of your strategy going forward.
Yeah. Well, the Fed's bringing rates down. I'd say we'll probably have 2 or 3 more cuts from here through the middle of next year, and then they'll probably pause to just make sure that they want to understand what the administration policies are. Are they inflationary? Are they expansionary in terms of fiscal policy? But ultimately, I think rates head back down to a natural rate, short rates at 3 to 3.5, and then hopefully there's an upward sloping yield curve, and the 10 years at 4.25 to 4.50. That's traditionally really good for banks because we tend to borrow money short and we lend it long. So an upward sloping yield curve really helps bank profitability. So anyway, I think we're kind of looking at the forward projections and making sure we've hedged the different scenarios. What if rates actually go under that because we hit recession, or what if rates stay sticky high because the tariffs cause inflation, or whatever reasons there may be. You have to constantly recalibrate as to what you think is going to happen, and then make sure that your balance sheet and your interest rate positioning is appropriate.
I want to ask you about the shadow banking system. Is that taking too much business away from banks, and is that adding risk to the system?
Really good question. I'd say you've seen over time that many traditional bank lending activities have migrated outside the banking system. Let's look at mortgages, and banks are only writing 30% of the mortgages that are being originated, and just moved largely to the non-bank sector. You now have this big private capital pool of funds that is looking to make inroads into the corporate lending space, lending to sponsors, et cetera. I think we have to play that in kind of effective ways where we're viewing them as customers and people who need credit and people who need opportunities to invest. so we can turn that into a positive. But at the same time, they're going to take some market share from us. And what's the kind of net balance of that? And so far, we've actually made more revenues from that trend than we've lost, but we'll see ultimately where that goes. I do think that it's important that we don't overregulate banks and turn the blind eye on other market participants, because you could build up systemic risks outside the banking industry by doing that, by encouraging opportunities and lending to move outside of the banks, which are heavily regulated. So we've been on that, beating that drum for a long time, like you should do to them what you do to us. But I think because ultimately we have the deposit insurance, it's never going to be a completely level playing field.
Right. Another new facet of the financial system is crypto. And I'm wondering what your interest in that is and what the bank's exposure or the bank's plans are in that field.
Yeah, so crypto's built on really interesting technology. So I think the whole industry embraces the blockchain and the potential uses for blockchain. I think the crypto as an asset class and as an investment is, I think, something that is more speculative. So we'll see if it actually comes to be something that most portfolios have an allocation to crypto. I don't think we're there yet. I think there's been a nice run. People think that a framework will be put in place by the Trump people, and there's a fear of missing out factor going on these days, which has kind of driven the price up to high levels. I think what is interesting is, can those tokens become a means of payment, and is it more accepted as a means of payment, which I think that's a long putt, quite honestly. So, I think it will mainly be an asset class that has appeals to certain type of investors, but doesn't have much broader use cases beyond that. So we can be a reasonably tardy follower on this. I don't think we have to be bleeding edge on this. If our wealth customers want to have the capacity to invest in it, then we'll be able to find the ways to do that that are appropriate.
Interesting. And your institution has been around for quite some time. You started
almost 200 years.
Right, in Rhode Island almost 200 years ago. But then in more recent history, you've had some experience with the Scots and the Irish.
Yes.
And I'm wondering if you could talk to us a little bit about that history and then where you are today and how you got there.
What's interesting is that RBS, I think back in the late 80s, bought Citizens, which was a relatively small community bank headquartered in Rhode Island, and used it as a platform to roll up a bunch of other Northeast and Midwestern banks. And kind of ultimately, when RBS failed, that there was a edict under EU law that they have to simplify and they have to sell off pieces to become easier to manage. So there's like a penalty for the failure. And I was I got recruited to go over to London and Scotland to help fix RBS in 2009. We were working on simplifying. We sold a lot of businesses, a lot of portfolios, and then ultimately Citizens went on the block. That was something that had to be divested, and it was almost impossible to get a sale to another bank through regulatory approval. So we decided, well, let's just take it public. So in September 24th of 2014, we took it public. It was the biggest commercial bank IPO in U.S. history. That sounds pretty fanciful, but usually banks don't go public. They get sold. So we had to avail ourselves of that liquidity mechanism, and then we sold off the rest of this position. In the IPO, we sold about 30% of RBS's position. We had 3 more sales to get it completely on our own by late 2015. And so we've basically been scaling the mountain to take kind of this little orphan that was owned by the Scottish bank and become a strong super regional player in our own right. And we've made a lot of progress on that.
And I mentioned Ireland because I think an Irish bank did have a pretty significant stake at one point.
Yeah, well, actually, I think it was the other way around. RBS also owned a major Irish bank that we had to clean up as well. So.
All right, stand corrected on that one. My understanding is you're seeing some improving consumer sentiment. Yeah. And I'm wondering what that is exactly, Bruce, and how that's manifested.
Yeah, so I think consumer optimism is pretty high these days, and we've seen people kind of go back to liquidity levels and borrowing levels that existed pre-pandemic. So it's been kind of a long ride through the pandemic and the aftermath with the inflation and everything. And but if you kind of flip the clock back 5 years and say, where were people pre-pandemic? We're kind of back to those levels. So our credit portfolios are kind of charging off and having delinquencies at about the same rate they did before. The consumer still is spending money. So one of the reasons we've been navigating this turbulent period is, people had to save a lot of money, and then they decided, I want to spend it. I have these high liquidity levels. Let me go out and buy things. Let me travel. Let me go out to eat. And so, we're seeing that trend continue. There's a little pressure at the lower end. People have exhausted their savings and are starting to borrow again, and so we're watching that. But our bank focuses more on mass affluent and affluent customers, so I don't really think that's a concern for us. And I think for the broader economy, it's not a big worry at this point, particularly if the economy stays strong, and it looks like the outlook is improving.
And again, referring to the new Trump administration, you talked about that a little bit, but are you recalibrating your strategy or the way you're thinking about the economy going forward based on this new administration?
I described our strategy in the triangle that we have with the three main businesses, and what I think that strategy works, whether we had a Dem win in this election or whether we have a Trump win. I think there could be a little more upside to the financial performance if the economy is going to grow a little faster, if there's more kind of pro-business policies and kind of a kinder attitude towards M&A generally, that should lead to more capital markets fees and the like. So I think at the margin, our financial performance could be a little better with this outcome, but it doesn't really change the strategy in any dramatic way.
With this maybe new, more friendly M&A environment, would you be a buyer or a seller?
We work for our shareholders, so we have to say we're open to both, but I'd say probably more a buyer if there's consolidating opportunities. We demonstrated an ability to execute well on this New York Metro play, so I think the regulators hold us in good standing. But having said that, I don't feel that we're compelled to go out and do a deal to get scale. We would only do a deal if it really fits our strategy and helps us get farther down the track faster in important markets or with different product capabilities. So, at this point, being successful in this private bank buildup, coming off the back of the First Republic teams that we brought onto the Citizens platform, that's a really big deal, and that can really positively impact our financials for years to come if we get that right. So that's like job one, is to make sure we execute that well, and we can just be opportunistic. If we see transactions, we can consider those. A lot of times what happens is you start to see the dance floor fill up and people around you are starting to partner, and then it almost forces your hand to consider doing something. So we'll just watch and see kind of how things progress over the next 18 months.
Watch things unfold at the dance. Final question to you, Bruce. A lot of people talk about work-life balance, and I'm wondering what your thinking is on that. What do you like to do outside of work, and how do you allocate your time?
Yeah, so I think you work hard, play hard is kind of my mantra. So you got to put into hours and really give 110% to everything you're doing for work. But same time, you have to carve out your play time as well and decide what is it that you like to do. So I try to play sports, golf, tennis, swimming. We have a beach house. I like to go to the beach in the summertime. And I now am a new grandfather. I have 2 grandchildren under 2 years old. So spending time with family and just seeing another generation grow up is really fun. So those are the principal things. I like to read. I've been doing a lot of reading in my spare time as well.
Congratulations on being a granddad. Also, I hope to see you out at the marathon next year.
Yeah, so I hear
Okay.
you're a big runner, which is
I don't know
great.
about that. We got to get you out there.
Not me running. I like to hang out at the finish line and encourage. I'm an encourager, but I'm not a runner. I said I'm a swimmer. So anyway, but hopefully our paths will cross next year.
Sounds good. Bruce Van Saun, thank you so much for joining us.
Okay, it's been my pleasure.
This is at Barrons. I'm Andy Serwer. We'll catch you next time.